Hi. So at Wright Research, we understand that the market does not stay the same all the time. There are times when the market, has a very risky scenario, and there are times when the market is very favorable, and trending stocks, trending portfolios do really, really well. So we understand this part, and to give you the best in all market scenarios, we have our core multi-factor tactical portfolios. These portfolios are present in three different risk profiles, and they have a lot of validity in the current market scenario when there is a little bit of risk in the market. So that's why we have chosen to create a video right now to take you through the multi-factor portfolios and show you how that portfolio can benefit you in all market scenarios. The multi-factor portfolio is a combination of not just stocks but ETFs that track bonds and gold as well, right? So while when the market is strong, like it was in 2020 and 2021, we invested a lot into momentum type of strategies because they were doing well at a low risk. But as the risk in the market has increased, this portfolio shifts to other factors in the market that might do well. And not just that, we even deallocate to bonds and gold when we see that the market is giving us a sign to make that deallocation, right? So a multi-factor portfolio is a serving of consistent market returns, and the ingredients are stocks, bonds and golds that have gone into this recipe. And with this recipe you can expect a consistent performance, not just in good market conditions but also in risky market conditions. So the primary rationale of this strategy is that the market will not always be the same, right? There are times when the market gives you a very steady return, like in 2017 to 18, if you look at the chart of Nifty, or if you look at the chart of the Nifty from 2020 March to 2021 end, right? The market gives you a very consistent and in certain phases, and there are certain phases when there is a lot of risk in the market, right? So it's a chart from 2018 and 19 when the market had, lots of ups and downs, and it was not, a one-sided trending market. But if you look at the portfolio mix, right? So if you look at this on the left side, we have 80% equity portfolio, and on the with the blue color and in the red color, we have a portfolio which has a high bond allocation. On the right side, we have the same portfolios but in 2018 and 19. And what you will see is that whereas in 17-18, a high equity allocation give you very consistent returns, but in 2018 and 19, this was not the case. And the portfolio where you had a higher bond allocation, right, higher low risk allocation, would have given you a much better risk, return profile. So that is what the rationale of this particular strategy is. We understand that in different market phases, different types of assets will work, and that is what we're trying to do with this particular strategy. And the idea behind is that we want to generate consistent returns in all market phases. You can see the return profile of multi-factor portfolio here. You see that in March 2020 it has given you a much lower drawdown in the market, and consequently it has given a very high steady return as the market has you know gone back into a trending phase. That's what we try to do with this portfolio, and that is what the rationale behind this portfolio is. So digging a little bit deeper into it, you know markets are not just about equity and bond allocations. There are a number of factors that help you describe the markets, and the main category of factors to look at are macroeconomic factors, where you are looking at GDP numbers, inflation, even global scenarios to understand what is the outlook for the future market. And then there is style factors, things like momentum, value, growth, and quality. They will consistently give you an outperformance on the market, and you have to understand those factors to get a steady return. So that is what our philosophy is, that we have a lookout on the macroeconomic side and also on the styles that affect the portfolio return. So the basis of this particular portfolio is the regimes that are there in the market. The market, like I said, has trending phases, but it also has risky phases. And we have to be able to forecast that in the future, in the next 1 month, what will be the market scenario. And that is what we try to do. So you will see that we have a model that is driven by artificial intelligence and a lot of macroeconomic and technical indicators that tells us what will be the next phase in the market. Recently, it has said that the market is going through a volatile phase, and that's how we understand that we have to lower our risk and become a little bit more conservative because there might be higher risk in the market. Uh, After realizing, the regime or the type of risk that is there in the market, we try to create the best particular portfolio for that market, right? Now, our philosophy is that the market is not just defined by, a single thing. The market is a combination of a number of factors, which is what we call smart beta factors or factor investing, right? We think the most important factors are momentum, quality, growth, value, um, and the size of the company, right? And looking at each of these factors and the market conditions, we have a AI driven model that gives you a forecast of the risk, and basis of that we pick up what to invest in the next phase. And that is what the underlying philosophy of this multi-factor portfolio is, that we're understanding the risk in the market and then doing our allocation based on what how the risk looks like. This particular portfolio, we offer it for three different type of investors, right? So there is a balanced investor who is looking to take medium term risk. There is a growth investor who is looking to take higher risk, and there is a conservative investor who is looking to take even lower risk. The same philosophy is given out to each of these types of investors. This is a data driven strategy. We are looking at everything using data and algorithms. There is no human intervention. And the philosophy, like I explained, is based on a smart beta and the macroeconomic market regimes. Combining all these smart beta and macro factors, we create an optimal allocation that give you a much better compounding than the simple market. Looking at what goes inside this portfolio, this portfolio will typically contain 20 to 30 stocks, and equity exposure can be anywhere between 60 to 100%. So right now, as there is a higher risk in the market, we see that some bond ETFs and gold ETFs also have slightly higher allocation in our portfolio, whereas you know in the previous year, equity had a much higher allocation in this portfolio. We are typically holding any stock in this portfolio for more than 1 month to up to 6 months to 1 year. You can expect 200 to 300% annual turnover in this portfolio, and this has a low correlation to the market. It has a 50% correlation to the market. Now, looking at the performance of this portfolio, you will see that this portfolio has been live for the last 2.5 years. And in those 2.5 years, this portfolio has given a 75% outperformance over the market. Whereas the market has only given a 50% return in the last 2 years, this portfolio has given 125% returns. And not only has it given a very good performance during the crash in 2020, but it has also picked up and outperformed the market by a whole lot after that, right? So, in terms of performance, this is a very consistently compounding portfolio. And if you invested in this portfolio for the long term, you will see a very drastic outperformance over the market. In the current market scenario, instead of people following returns very aggressively, there is a bigger sentiment of safeguarding ourselves from the market crash, right? So this portfolio is designed to be robust in market crashes, right? So if you look at a condition like what happened in March of 2020, you will see that when the market crashed almost 40%, this portfolio only crashed 15% and quickly recovered, thereby saving a lot of pain and a lot of tension for our investors. And this philosophy is ingrained into this portfolio, and we try to implement that to give a good performance to our investors. So these are the scenarios, some difficult scenarios that we have seen in the equity market, and you will see that in March 2020, when the market crashed drastically, all the three versions of the portfolio, conservative, balanced, and growth, did much better than the market. The balanced one gave a 15% drawdown, and conservative even gave a much lesser 7 to 10% drawdown. And same thing in another crash that has happened in 2016, where these portfolios outperformed the market a lot during such drawdown events. That's why it is very important for us to understand and look at this portfolio and the importance of it in the slightly volatile condition that we are seeing right now. This portfolio gives you a lower risk than the market in all the years in the last 8 to 10 years. You will see that in each year this portfolio has given a much lower risk than the market, and the performance or the risk adjusted return of this portfolio has been much higher than the market in all market scenarios, right? So talking about the current market scenario, when there is a lot of uncertainty about crisis in Ukraine, the Fed rate hikes, the COVID worries, the rising crude prices, and things like that. Uh, this is the time when we need to be a little conservative and make sure that we are protecting the capital. So in this portfolio, which recognizes that we are not in a trending regime, but we are in a volatile regime, we have deallocated a little bit out to gold and bond ETFs. And also among our equity allocation, we are shifting more towards, value factors in this particular portfolio. We expect the markets to remain robust, but predicting geopolitical uncertainty is beyond any financial or macroeconomic model. But the risk management will be very very tight in this portfolio as well as in all the other right research portfolios, so that we safeguard our investor wealth during any uncertain market scenario. Uh, so we are deallocating a little bit in this and the other portfolios, but the long term outlooks obviously remains very strong. Geopolitical crises usually go away very soon, right? I mean, in terms of looking at the market, not the real life misery that they're facing, but the markets tend to adjust towards these man-made crises quickly. Obviously, there is another worry of crude prices and US rate hikes and things like that. But even despite of that, Indian economy is strong right now, and we expect to remain strong, and the markets will recover and start getting stronger in the future. That's what our outlook is. But in the short term uncertainty that we are facing, all our portfolio will adjust and give you the correct allocation to safeguard you from this volatility. So that's why it is very important for us to look at the multi-factor portfolio, and that's what I wanted to talk to you about in this video.